Thank you, guys. Thank you so much for being here today. I want to start off by thanking you, Lillian, for this opportunity. It really means a lot to me. I had this intention that I wanted to start speaking a little bit more, and then all of a sudden I get this opportunity. So I'm very grateful for it, very grateful for the chamber and the accommodation and the spicy snacks. Very spicy. So let me just talk a little bit about myself, and then I'll jump into all the stuff we came for. We started the firm in 2014. We're 13 amazing individuals, and one of the things I strive to do, as many of the business owners in this room want to do, is, right, we want to duplicate ourselves. We want to replicate and find and train amazing people that are going to have the care that we have with our clients. And I feel that we've done that. In fact, recently we won one of 60 businesses that are the best places to work in South Florida by the South Florida Business Journal. And we're actually going to be attending that event at the end of this month to receive that award. So very, very exciting. Yay. All right. So what is the best tax structure? I feel like starting with this topic is really important because the structure that you set your business up really lays the foundation for how you're going to be taxed. And a lot of the answers that we have to these questions in accounting are always, it depends, right? Well, it depends. So when I do these presentations, it's a bit of a struggle because the room is usually varied. People from different industries, different backgrounds, different ages, different demographic, family situations. And so what might be the best tax structure for you isn't always the best tax structure for somebody else. The worst thing you could do is get advice from TikTok, right? But I get a lot of clients that say, well, TikTok says I should be an LLC, right? Or social media, if we're not going to use the word TikTok. And so one of the things I like to demystify here is the fact that an LLC, at least a single member LLC, is the same exact taxed treatment as a single person getting paid to their own personal name. There's a common misconception that by incorporating as an LLC, you're going to get some additional tax benefit. And that's not true. LLC, which attorneys in the room can tell you, is a legal structure, right? And so when we talk about what's the best structure for me from a tax perspective, it's not necessarily going to be the LLC if all you're trying to achieve is the ability to take deductions. Because you can take deductions even if you're paid to your own personal name. Some of the other structures that we talk about that completely change your tax situation are an S Corp or a C Corp. These types of entities will completely change how you are taxed and how you are viewed in the IRS's eyes. Starting with a C Corp, we typically see this for large corporations, but we have seen it a few times for smaller ones where it makes sense. This is a company, C Corp, that files its own separate tax return, and all of the income, expenses, net income stay inside the company and the taxes and all of that. In other words, when someone says, my business had to pay tax, they're likely talking about a C Corp. Right now, C Corps have a preferential 21% flat tax, which is not very common because before that, it was 28%. And before that, it was actually a graduated rate that was even more expensive. So over the last 10 years between Obama and Trump, and I'm going to say president's name not from a political, but just kind of to understand the timing of when things changed, because they changed them. Over that course, they have made the C Corp more and more lucrative. And C Corps are typically entities like Amazon or Apple. They're these big entities. But we are seeing that startups, for example, are sometimes starting as a C Corp because the owner wants to keep the structure separate from their personal taxes. They don't want to flow through. They want to be able to get VC, venture capital. They want to be able to get foreigners to invest in their business. And there are rules when you're a different type of corporation that you can't be those things or have those things if you're set up that way. So there are times where I will talk to a taxpayer and we will decide that C Corp is the best fit. But most small businesses, most family small businesses, most closely held, most businesses where the owner is some sort of consultant or performing the trader service, the C Corp is not going to be the best route. One of the most common and best routes is probably going to be the S Corp. And so I'll just talk about the differences, right? An S Corp, the S kind of stands for small. It's seen as being closely held. It's usually less than, or has to be, less than 100 shareholders. And the treatment ends up being a business tax return separate from the owner, same as before, but now there is no business tax that is paid. There's another common misconception there that my business is paying tax. It's not. What ends up happening is the net income of your business gets put onto an additional form called a K-1, and that K-1 form now gets included in your personal tax return. So many times when I do a tax return with an S Corp and a personal, I'll tell the business owner, okay, your tax due is, easy numbers, $1,000. They'll say, okay, now how much business tax do I owe? No, that's the tax, both of them combined, because ultimately the business lands on the personal. And this is good for a few reasons, right? It's good because it allows you to be able to take distributions from the business without a second taxation. It allows you to take advantage of the losses. So if your S Corp has a loss, you can actually offset that on other things that might be going on, like a W-2 from somewhere else, or earnings in the stock market, right? There's different things that we can use that loss for on your personal tax return. So when we decide on the structure, we look at all those different types of things, right? Do you want to be able to take distributions? Are you going to have a VC investing in your business at some point? Are you a foreigner? How many business owners are you going to have in the business? Are any of them going to be foreigners? And so from there is when we decide the best tax structure. Usually small, closely held, you're going to see it being an S Corp. Any questions about structures? Yeah.
On the S Corp.
Yes.
You just said that the taxes are together.
Yes.
So whatever you made in the corporation goes on top of your income as a personal?
That's correct. So ultimately, what the individual tax return will say is the individual tax return has all of your income from all the sources. It has the W-2 from the job. It has the capital gains from the Amazon stock you sold. It has the rental income from the rental property. And it has something called K-1 income, which is from these businesses. And so your adjusted gross income, which basically is your total income, will be consistent of all of these different things. When a business owner still persists on asking me how much of the tax owed is from their business, I will just take their bracket and multiply it against the business income to give them an idea of what impact their business had on their overall picture. You still have to file 2 separate tax returns. That's never fun, but yeah, they're end up combined. Yes.
You said that there's a K-1, and whatever percentage you own of the company, that profit goes to you.
Right.
Now, I've heard that there are times where a company will actually make money but doesn't have any positive cash flow.
Right.
Does that mean that you can get stuck with a tax bill but you don't have any cash?
Yeah. Let's talk about when that happens, okay? So sometimes your business has profit and you have expenses, and you decide to use that profit for other things. For example, you might decide to purchase equipment, or you might decide to pay debt, okay? It's the end of the year, and now that equipment that you purchased this year is only 80% deductible. It's not 100%. So 20% of that equipment you purchased is not a write-off. So right there you still have profit. Or the debt that you just paid. That's not a write-off either, because when you received the funds from the loan, you didn't pay tax on it. Therefore, when you pay back the debt, you're not getting a deduction. The write-off is the interest that was created, right? So we then have a tax bill and we don't have the cash for it because we paid all this debt and we did all this equipment. And what you just highlighted is why it's so important to work with a tax advisor, right? It's to work with a CPA, because sometimes the decisions we make in our business, while, let me tell you, it's good to pay debt. Your net worth went up. It's good to buy equipment. You probably are making more money in your business because of the equipment. It still might not impact you that greatly for it. And there's other, there's ways around this right now. Actually, on the way here, I was reading that It's 80% bonus depreciation this year, but Congress, right now, I don't know if you guys know, they're going to run out of money again, right? So one of the things that they're doing to get some more money is they're trying to figure out what they want to put in this bill, and Republicans are really trying to get 100% bonus depreciation retroactive to this year and all the way through 2026. It was 100% last year when we did the tax returns for the prior year. This year it's 80, it's supposed to go down to 60. We don't want it to go down, right? We want that every dollar we spend, we actually get a write-off for it. And so it would be very lucrative if it went back to 100. With that said, that's why you want to work closely with a tax advisor to make sure that the things that you're doing, for example, it is more beneficial to finance equipment than it is to purchase it 100% from a tax perspective, because you don't put all the cash out for the equipment, but I get an 80% write-off, right? So from a tax perspective, that's a good thing. But from a net worth perspective, you just increased your debt, right? And you're leveraging yourself, so you better believe in your business model, because otherwise you're going to be left with the debt. So there are things that we do that are beneficial for tax, but they're not always beneficial for your net worth. And a lot of times what's beneficial for your net worth isn't always beneficial for your taxes.
So there are LLCs that are also included in personal tax returns
Yes.
as corporations.
Yes, so let's talk about that. You can convert an LLC to being an S Corp. At that point, you are still an LLC by name, but for tax purposes, a CPA is going to call you an S Corp, because in the eyes of the IRS, you're no longer an LLC. You remain an LLC by state charter. Florida recognizes you as a limited liability company and your name stays the same. But for the IRS, you become an S Corp. So one of the things we do as CPAs is we determine, is it suiting you to remain an LLC? At what point do I convert my LLC to being an S Corp? And I'm going to answer that question for you. There is more compliance with an S Corp because you have to file a separate tax return. So the CPAs are going to charge more, right? More work. Number one. Number two, S Corps require you to pay yourself a reasonable salary. To pay yourself a reasonable salary, 941s, RT6, W-2s, the tax forms go on, and there's different deadlines. So you get a payroll company. That's going to cost you. We start to add a lot of costs when we become an S Corp. And in my business, we always look at cost versus benefit. How much is it going to cost me, but how much am I going to benefit by, right? If I'm paying my CPA X, I want them to come up with that much more in tax savings for me. So the same thing here. If I'm going to recommend for you to be an S Corp, it's not for me because I'm going to get more money doing payroll. And no, it's because you are going to make more money in tax savings. And we can usually figure out by multiplying how much you're making against a 15%, because that's roughly how much LLCs additionally pay in self-employment tax. Example, $20,000 net income is roughly $3,000, 15%, right? Sort of. So you want to be spending less than $3,000 on your tax return and payroll, and then you'll be saving. So anything above $20,000 of net income, we know, oh, the savings, they're enormous, you know. There's an opportunity there for sure. If I was a single member LLC, the question that I would be asking my CPA this year would be, is it time for me to elect S Corp? Yeah.
Try to keep the question.
I'm not sure
Okay.
if it's actually for you or for Lily.
Say that again? Oh, for you, for me, or for Lily?
There's kind of a follow-up to my other thing,
Yeah.
which is about where there's profit, but there's no cash.
Yeah.
And this is kind of the bad partner thing, and I've had bad partners in my life. So if one partner doesn't need money and the other needs income, but the one partner has a larger percentage and decides, well, we're gonna buy the stuff and we'll pay the tax and not worry about it, is that the kind of thing we need to talk to Lillian about when we set up the corporation? And
Yeah.
put it
Well,
into
I'm
our-
gonna answer this generally. You know,
Yeah.
it's not just the tax consequence of being a C Corp or an S Corp, and under an LLC, you can be either a C Corp or an S Corp. Like a lot of people call us, I'm a C Corp, I'm an S Corp. I said, okay, but do you have an LLC or do you have, are you incorporated? Because it's two different corporate structures. And so all the things she said, you know, what's gonna happen in the future? Are you gonna franchise? Are you taking partners? Are you going to be raising money? Those are all things that we have to talk about. before deciding, are you gonna be an LLC or a corporation? And then how are you gonna be taxed? Because it's two separate things. As far as your partner, we can talk about that, or partner, we can talk about that offline, because she has to get to number 2, I think.
Yeah. We work in cohesion with the attorneys to set that up, for sure, yeah. The second thing I want to talk about, a lot of people think that income tracking is the most important, and it is very important to know your income, yes, certainly. But your income, the IRS also knows about it too, right? They'll get 1099s, they'll get the 1099K from your merchant provider, they'll get the 1099 that somebody else issued. They will know how much you made. What they don't know is what your expenses are. And so I tend to emphasize this a lot. Tracking how much you're spending in each category, not only for your own benefit for budgeting purposes, but also for tax. Because every dollar you didn't track is another dollar that you paid in tax, right? Every dollar you don't track is a percentage that you didn't pay in tax. And so the next question in this whole conversation of tracking is, do I need to keep the receipts? The answer is yes. Now, we have to be realistic, right? There's a threshold. You don't necessarily need to keep the receipt for the $20 Amazon order of pens, but guess what? Amazon has receipts, and they go all the way back. So there are a lot of things in this day and age with technology that we already have receipts that have been generated. Credit card statements are not enough. The IRS won't accept it in an audit. What you want to do is the ones that you cannot retrieve the receipt, the meal, that's a big one. You want to try to take a picture, right? Again, this day and age with technology, we have things like Expensify, and now QuickBooks itself, you can actually take pictures and connect it with expenses. Because in the event that something is challenged, the IRS is gonna want the receipt. Who'd you meet with, what'd you discuss, when, all of the information. And so this is where, depending on the
Picture is enough on QuickBooks, anyway.
Yes, the picture of the receipt.
Of the receipt,
Yes, 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 yes. We want enough information to be able to defend. What I was going to mention here was this is where bookkeepers come into play, right? Bookkeeping firms and bookkeepers. Sometimes we're so busy as business owners and we don't have the time. And the return on investment is how many expenses am I leaving on the table by not having the appropriate bookkeeping being performed, right? Because if I'm not doing it and no one else is doing it, and at the end of the year I'm scrambling to do it, I'm saying, well, my phone was about this much, it's not going to be enough. You're definitely leaving, some money on the table there. I wanted to get into some strategies, and at the end, I also have some stuff on retirement accounts and how we use retirement accounts to save. But since we're talking about how to avoid taxes, strategies are the key here, right? There's a lot of different things that we can do. And it just depends on what industries you're in and what you're invested in. And that's why you want to have an accountant that is aligned with the industry that you're in, that has worked with. So when she was saying the list of different types of people, those are recurring themes. A big one that many of the room might appreciate is real estate, investing in real estate. Does anybody know what a cost segregation is? Cost segregation? Oh, this is so much fun. Okay, so real estate is one of the beautiful ways where you can grow your net worth. There's your business, there's real estate, there's stocks, and then there's alternative investments like other businesses and gold and oil and all that stuff. But what I'm focused on right now is real estate. Whether your business is involved in real estate, the purchasing, the buying, the flipping, the renting, or whether you just kind of have a property on the side, the reason why real estate is lucrative is because your rental income minus your expenses, depreciation, usually you don't arrive as high of a net income, which means you usually result in very little taxes. The reason being the depreciation. So what is depreciation? I buy this property, and the IRS says that over this period of time, I can deduct the property. The property is $100,000, no such thing in Miami, but $100,000, 27 and a half years for residential, so your deduction every year is $2,750. Boop, 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 boop. With something like cost segregation, we hire engineers to come in and say, well, this building of $100,000 actually has components. There's furniture that's worth $5,000. There's fixtures, there's appliances, and they separate the $100,000 purchase into buckets. Buckets that are depreciated faster than 27.5. So what we do is we accelerate deductions that we would already get in the future. We accelerate them today. And the value of money, Finance 101 tells us that money is more valuable today than it is tomorrow. If I give you $1 today, you want it today. You don't want it in a year because you can put it in his bank and earn some interest, right? So cost segregation allows us to accelerate depreciation. Usually that results in a very large loss. That loss, we then offset against other income, and then we reduce our tax bill. I'm gonna give you an example, a story. I have a daycare client, has 6 different daycare. He's going on his 7th daycare. He's shifted from just buying the daycare business to buying the business with the real estate. Beautiful. 7th daycare comes. This building is $1 million. And I tell him, we've got to do cost segregation. Cost segregation, what is that? We get the engineer involved, and the engineer says the report's going to be $6,000. And he's like, Tiffany, cost versus benefits, $6,000. And I'm like, trust me, please. So we involve the cost segregator, and he determines that approximately $250,000 of the purchase is in buckets of 5 years, 10 years, and 15 years. The good thing about those buckets, I just told you, they're 80% deductible this year. So I can accelerate 80% of $250,000 today. Whereas with 39 years, which is commercial depreciation, his deduction would have only been $3,900. Now I'm depreciating whatever 250 times 80% times 37% taxes. It's over, I think we did the math, it was like 30 to 40 something thousand saved in taxes. And all he did was pay $6,000 for a report. So I look like a rock star, and the client saves a bunch of money in tax. He doesn't avoid taxes 100%, but he avoids enough taxes where he can take that money and look for his 8th daycare.
This is for only for new, or is it for existing?
So this is for when you purchase a brand new property. Unfortunately, because depreciation is something that flows year to year, it's very difficult to retroactively do it, and you'd have to amend tax returns from the day you put the property into service. So usually we will only do it in the year you purchased, or maybe a year later, so that we're only amending 1 or 2 tax returns.
But it's new. What I meant is the asset is new, or it's already existing.
So it's a new asset in the sense that it's new to you. Like the property could have been from 1940s and you bought it today. Yeah. Any other questions about this?
Can you refinance the property?
Yes. So then there's so many beautiful things that come from this, right? Because you can refi, cash out, and then there's no tax in refi, cash out. The second thing I get told as well, when you accelerate depreciation, you're lowering your cost basis in the property. You actually didn't buy that property for $1 million anymore. You bought it for $750 because you already deducted $250, right? So when I go to sell it, my capital gain is going to be really high. I don't want to do cost segregation. So I don't always recommend this to like a flipper, right? I don't want to recommend this to a flipper. This is who I'm recommending it to. I'm recommending it to this client because he's not planning on selling that daycare for a minimum of 5 to 7 years. And he might even decide to leave it to his heirs, which means his heirs would get step-up basis. So nobody would ever pay the tax on that cost segregation. Even if he didn't give it to his heirs, he can do Section 1031 exchanges where he just buys like-kind properties over and over again. So you create this generational wealth with a cost segregation, a 1031 exchange, and step-up basis.
That investment that he made, in your example, the $6,000, it's that one time.
Yes.
But then you're carrying that over
Year over year over year. Yeah. So then the following year, we have the remaining 20% on those 5-10 year buckets at those shorter time periods. And then the remainder he still has at the 39. Yeah. So it's one of those things where we look at cost versus benefit of what it's going to cost us. And the numbers made sense there. This doesn't make sense for a flipper. It doesn't make sense for properties under a certain value because the minimum cost of one of these reports probably is $2,500, $3,000. So you're going to want to, and I'm sure you can find, this is the company I work with nationally, but I'm sure there's others. You're going to want to make sure that the property is expensive enough where this makes sense. Yeah. Any questions? How much time do I have? What time am I going to?
You have about 10 minutes.
Okay. I can go
We
to,
wanna hear all the ways that we don't have
Yeah.
to pay taxes.
yeah. I can get into retirement accounts next, but before I do that, before I talk about specifically like which retirement accounts are the best and this and that, offering retirement accounts right now in your company is very lucrative because there's a lot of tax credits surrounding this. The recent Secure 2.0 Act that you may have heard about, which is now requiring employers to at least give retirement options to their employees of certain sizes and based on part-time, all these things. The point is that there's a lot of incentive right now in the market to give retirement accounts if you have employees. Whether you have employees or not, it's always lucrative to put money in your own retirement. And here I get a lot of questions like, okay, there's a 401k and there's a traditional IRA and then there's a simple IRA and there's just so many options. Like, where do I go with this? And the first thing I'll start with is how much money do you want to put away for retirement annually? Because the more money you want to put away, the more we'll get complex and introduce these costs because we got tax savings. But let's say you're starting off with, well, I just want to put away $7,000 this year. That's great. We don't have to do anything with your company. We'll go with a standard IRA in your own personal name. And then we can have a discussion of should we go the traditional or should we go the Roth? Should we get the tax savings today and have a tax bill later? Or should we get no tax savings today but have no tax bill later? Once clients start telling me, okay, I think I'm ready to put away $20,000, $30,000 a year. Now we're going to talk about 401ks. We're going to look at your business. We're going to see whether you have employees, because once you have employees, if you have a 401k for yourself, you've got to offer them too. So what is that going to cost you versus benefit you, right? Or if you don't have any employees, let's go with an individual 401k. In those instances, we can avoid something called a TPA, third-party administrator, and we can max out your 401k with limited costs. Still more costly than a traditional IRA, but the difference there being I could put away 30 instead of 7. And the more I put away, multiplied against my tax bracket, is the tax savings. Anytime you want to know how much you're going to save in tax on something, you look at your tax bracket or the last one you landed and you multiply it. That's what you're going to save. It's an easy, rough, fast rule. For retirement accounts, right? If a client were somewhere in the middle, I don't want to do 7. I don't want to do 30. I kind of want to do somewhere like 15. We might go with a simple IRA, which is essentially a combination of an IRA mixed with some sort of business type 401k. It has less fees than a 401k, but you're capped this year at 15, right? And so you can get double the tax savings doing something like a 401k. All of these, to do any of them, you have to have an official salary. You have to have a payroll. You can't just be taking distributions from your company. And again, having a payroll adds a little bit of costs. Any questions so far? I might tell you, your tax bill is $5,000, but if you put $7,000 into your IRA, traditional, we can save $1,400. The thing is, you have to have the cash because you're going to put $7,000 there, and you're still going to have a tax bill of $3,600, right? If I did the math in my head right, $3,600. So you need $10,000, right? And so sometimes clients will tell me, no, I don't have that much cash, but you do save the $1,400 from going to the IRS. You kind of make the $1,400 go into your IRA. When to plan? So we're talking about saving as much as possible, and you know, and you highlighted it, Ken, in the back. It's that you have to work with your accountant on a more frequent basis than just once a year, right? It's a two-way street. And the more that you engage with your CPA, I find that clients get the most ROI from. So at a minimum, my thinking is clients should engage with their CPA twice a year. Once around August to October, and again during tax time. But some of my more organized and aggressive clients that I love will do more than once a year, like summer and then fall, to see what they didn't do in the summer, because they got recommendations in the summer from me. So maybe they implemented 2 or 3 things, and then they're recapping in the fall, like what can I still do or didn't do? And then by tax time, they've got all their P's and Q's squared away. With clients that we work with monthly doing their books, we're looking at this quarterly. We're looking at it every quarter. And different quarters, we're motivated by different things. Quarter one, it's more about, is the year kind of going the way you thought it would? Do you need to make an estimated tax payment? And then quarter two, quarter three, we start talking more about tax. That's summer and fall. And quarter four, it's like, this is what the year was. Let's start working on your taxes. Any questions? How many minutes do I have? I have 1 more minute? 1 more minute, 1 more minute. Okay, so a common question I get asked is estimated tax payments, right? You're supposed to make them every 3 months. When I tell you that less than 10% of my clients make them, right? Everyone's like, eh. What you don't realize is that your tax bill that you're being told each year has an embedded cost for not making that payment. On average, you are paying about 5% more on your taxes than you would because you did not make these estimated payments. The thinking here is when you owe more than $1,000, the next year, if you make the same or more, you know you're going to owe. The IRS knows you're going to owe. Everybody knows you're going to owe. So the IRS wants to charge you interest because in their mind, that money belongs to them. And so since you got to leverage that money all year long on your side, they want a piece of that pie. Now, I have clients that do very well, and to them, 5% doesn't make any sense. They reinvest it into something, it makes them more money than that. So I tell them, hey, you could have saved $3,500, $4,000 this year if you would have made your estimate. I made more than that. I don't want to give them all that money. Okay. Well, I have other clients that are like, I want to pay the least amount of possible. And since this talk is about the least amount possible, you have to make your estimated tax payments. You get the recommendation of how much to pay based on your last tax filing, because that's the next thing. Well, I don't know how much to pay. It's always based on last year anyway. So if I tell you you owe $10,000 this year, your estimated tax payments are likely $2,500 next year divided by 4, right? 10,000 divided by 4, $2,500. If you happen to be making more, should you send more? Yes. Do you have to? No. Because you only have to send what you owed the year before, assuming you make the same or more. If you are making less, this is a super common question, right? You don't necessarily need to make the estimated payment. However, if you end up making more at the end of the year, that could mess the whole thing up. So looking at 2020, COVID hits, right? March. Q1 is due April 15th. How many people you think sent their Q1? Even people that normally sent their Q1 did not send their Q1 because they had no idea what was going to happen in the world. Thankfully, the IRS came back and waived all penalties related to paying that first estimated tax payment, right? Thanks, government. But normally, this is what we see. We see, okay, I have fluctuating revenues, maybe I don't send as much. And that's where you work with the accountant to say, hey, I know my recommended is $2,500. Here's where I'm at. I think I'm doing less. What do you think I should send? And we go back and forth on what it would look like cost-wise if you didn't send the whole amount. So I see this as a common area. Last thing I'll say about this in particular is there's a common misconception that when taxes are due April 15th, you can get an extension. Yes, for 6 months to file your paperwork. You can't get an extension to actually pay your tax due. So what happens is if you wait until September, October, you won't get a penalty for filing late the paperwork because you filed an extension, but you will get hit with penalties and interest for paying them so much later. So when you file your extension, because extensions are okay, they're inevitable, they're fine, you don't have all your documentation in time. It could be a partner, like Ken's partner in the back that just hasn't sent him the K-1. But you have to work with your CPA when you're doing the extension to make the estimate, right? So here's what I have as far as what I think my income is. What do you think I should send? Here's what I want to send, and then you make a payment.
But in that scenario, if you had been paying quarterly,
yes,
then you would avoid that because you've already prepaid?
Sort of, because what we're going to do is we're going to reconcile. So let's go back to the example of $10,000. You prepaid $10,000, and then it's extension time. And I see, wait a minute, you made a lot more than last year, so you're actually not going to owe this year, you're going to owe 15. I want you to pay that $5,000 difference on April 15th, because if not, you will pay that tax after 5. Any payment after April 15 is subject to an additional amount. Yeah, yeah.
I think we all know about the, I'm sure every small business owner here expenses the heck out of their income. But can you talk about maybe unusual expenses that maybe we don't think of? I mean, we all know about rent and utilities,
Yeah.
payroll. Are there any types of expenses we should be on the lookout for?
Chamber memberships.
Yeah.
That is one.
Yeah. You know, I've seen some things. I've seen people deducting, trying to deduct their dog, calling the dog a security pet of the house. And for my business, he's security for my business. Yeah, but that's not one of them. What I can tell you is the 3 or 4 different ones that the IRS looks at more closely, so that when you decide what you're deducting, you think about these 3 or 4 categories. First one being travel. We all want to deduct all of our travel. We have to be careful with that. The second being your auto, right? There's a lot of personal use of the auto, and so the IRS likes to question that, mileage logs, things like that. The third being meals. And I think that's pretty much the top 3. The third one being meals. Did you have the meal personally, alone? You know, I was doing a video this past weekend, and it's crazy. Like, you could have a meal with your employee, and that is only 50% deductible because the entire office was not invited or present. Or you can have a lunch at your office for somebody's birthday, and that is 100% deductible because the entire office is present. You could have a meal with your client, and it is 50% deductible, but you can't send them on their own because then that's a gift and it's up to 25. So meals starts to get really tricky depending on who, what, when. And since the IRS knows this, they'll look at, you know, a deduction and say, let's question it. And what I've seen is they, you know, I get told this a lot. Well, I'm a small business. What does the IRS care about me? No, they don't. The computer does, right? The computer goes, deet, 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 boop, puts your tax return aside, and then a real person will look at it. That's how it works. And, you know, they can also audit line items. So sometimes a client thinks, well, they're not going to audit all it's too much of a hassle. No, what they'll do is they'll just question one specific line item and ask you to send the information for that one. So auto, send us your mileage logs, your receipts, you know. And so I still stress that when we look at expenses, they have to make sense in the story of what your income is, right? How high are your revenues relative to what you're doing? If you're in the travel agency and you have travel expense that's really high, and you're in the travel, you know, industry, some sense, that would make sense. You know, but if you're a veterinarian that has a local office with clients that are all local, why would you have such a high travel expense? Yeah.
And how about travel associated with conferences? Can you deduct the whole thing?
Yes, but there is also a per diem, especially for employees that are with you, that you have a maximum of technically how much you could deduct. So like lavish dinners, for example, post-conference might not be, you know.
So it should be a lavish lunch, or?
No, it should not. Dunkin' Donuts. Yeah, no. Yeah.
All right, we have about 10 minutes for questions, and then we're gonna wrap it up with the networker.
I have a question going back a few slides. So
Yes.
if you deducted building in the bucket and you're going to depreciate.
Cost segregation.
Depreciate at 80%, but then what happens if the dream comes true and we go back to 100% depreciation? Do you get to revisit that?
Yeah, so what they're trying to do is they're trying to retroactively make this, you know, it's kind of insane to me that they pass things well after the year has closed. They do this every year. And I don't know if you remember, like with unemployment compensation during COVID, it was taxable. And then all of a sudden they're like, no, the first 10,200. And don't worry, if you already filed your tax returns, you're going to get an automatic refund. Don't amend. Like an insane amount of paperwork, people calling, saying, I still want to amend. I mean, like, they just create so much confusion. So if you file, first, the IRS just recently opened for businesses on the 12th. They don't open for individuals until the 29th for e-file. So if you already filed your business tax return, which very few do, on the 12th, and they retroactively approve this, then you would want to do an amendment. So my recommendation would be kind of hold off, yeah, and just see what they're going to do, because they do have to make a decision soon.
And then I have another question.
Yeah.
Why did you decide to be an accountant?
Why? Yeah. I like problem solving, so I like puzzles. I like to find where the pieces fit. And starting with financials, you have debits and credits. Everything has to equal. Everything has to make sense. There's a lot of truth to numbers, though people do some funny business. There's a lot of truth to the numbers. And then I also like learning about all these different rules, these different loopholes, if you will, for myself. And so then I thought, well, if I'm going to learn about it for myself, let's help other people with this too. So, that's why when I talk to clients, they're like, well, how well do you know about this? And I'm like, I know as good as I want to save on it too. So if it exists, I'm doing the research. So then with that in mind, I had an aunt of mine that was working for the University of Miami as a controller of one of the 6 hospitals, and I interned as in high school, and I just loved being involved in a controller's office. And then, and I just decided that I wanted to be, I actually had a counselor tell me that I have too much personality for an accountant. I should be in marketing instead. Yeah, and I was like, no, I'm gonna change the industry image, that's what I'm gonna do. So, thank you so much. I definitely like this aspect, is making the jargon, eliminating the jargon and trying to make it as easy as possible, for sure. Thank you.
Question on the real estate investments or transactions, what percentage of the closing costs and points are deductible?
That's a great question. I'm pretty aggressive with all of it. Now, we do that on the sale, right? So when we sell the property, we want the HUD, closing disclosure of the sale, and we want the closing disclosure of the purchase. And sometimes, after 20, 30 years of holding on to that property, the clients don't always have that. So they miss out on that deduction, because if we don't know what they are or have proof of what they are, then I can't really deduct it. But yes, closing costs, title, those are all professional fees that you're paying in the process of the transaction. So they are, to me, 100%. Yeah. Those can add up, I heard. Not with her. But they provide value. So that's actually something that I talk about a lot in conversations about how long you should retain documents. And usually I recommend 6 years. 6 or 7, because the IRS can go back 3, but if they can prove that you left out about 20 to 25% of your income, they can go back 6. But when it comes to real estate, I say for the lifetime of the property, as long as you have it, all of the improvements, that's another thing that sometimes people miss out on, right? They may have done the roof 15 years ago. I want to deduct that now that we're selling it, and they don't have any documentation. So my recommendation is for real estate investors, even if it's just one property, you have folders with each property address, and you've got everything in there from the closing disclosures to the, improvements and the fridge you bought and all of that. Yeah. Hi.
Question. So if you're planning to buy a new property and put it in LLC, when is the right time to contact you?
That's a great question. Well, first you're going to have opened the LLC, right? That's first. And then you're going to close, right? You're going to close. And then when we're going to get ready to put it on your tax return. And I'm assuming that if you're going to buy an LLC, it's probably an investment that you're going to make rental income on. It's not going to be your primary home. And so there, after you've made the purchase is really when we would get involved.
Wouldn't you want to close under the LLC to avoid having, it's not much, but the
Yeah.
transfer tax?
Yeah. So that's what I'm saying. She would open it first, then you would be under contract like with the LLC and close and everything. Transferring it to the LLC after the fact is definitely going to create some stuff. But just so we're clear too, putting the property in an LLC does not change what you can deduct. It's one of those things where your attorney tells you about how you're limiting your liability and doing that. You're still going to have the same type of tax benefit, you will, as if it was in your personal name. If you purchase a property or open the LLC with another partner, and that partner is a relative that doesn't file with you, as in not a husband, then, or spouse, then there might be tax implications as to how much that might impact your return versus theirs.
In that situation, the property the LLC that's holding the real estate has to file its own return as well.
Correct. And that's where we talked about the property files its own return. Each one gets a K-1 for their percent of ownership. Yeah.
Is cost segregation something that would apply to a piece of land as well?
Nope.
Does it have to be a structure?
It has to be a structure because land is not depreciable. So if that person were to renovate and build on the land, even the smallest structure, we would talk about cost segregation. Yeah. Great question. Thank you guys so much. It was such a pleasure. Tiffany Gonzalez at County Jail. Thank you, thank you. Thank you, thank you.
And you always want to have your CPA go like this when she's talking about your money.